Whether you're in your 20s and just starting your career, or in your 40s and getting your family started, or if you're close to retirement in your 60s, we have the data on those decades and everything in between. I'll also cover what your goals should be in order to set yourself up for a nice retirement based on where you are. As always, I'm gonna leave timestamps below in case you wanna skip around to your section, but let's get started with the decade of the 20s. The median net worth in your 20s is $6,689 as of the most recent data from Empower, and the average is over $127,000. Now, this is a huge disparity, obviously, because individuals with really high net worths are skewing the average upward. That's why I think the median is a better metric to pay attention to, because it represents the middle point of the distribution, giving you a clearer picture of where most people actually stand. Now, net worth is simply defined as the total value of everything that you own, your assets, and then minus everything that you owe, your liabilities. I personally track my net worth in a Google spreadsheet, and I wanted to give you guys a visual, so here is a very basic net worth calculation. You can see here you have 10K in a checking account, 20K in a retirement account, but you owe $50,000 in student loan debt. Therefore, your net worth in this case would be negative $20,000. So that's how you would calculate your net worth. Now, in your 20s, you want to be able to target a median net worth by the time you are age 30. So what is the net worth that we should be striving for by the time we are 30? Well, the answer is $52,002. That's because by the time you are 30, Fidelity recommends that you save 1x your salary for retirement. Now, since the median income in America is $52,002 as of the age of 30, we should be aiming to have that much in our net worth by the age of 30, if not more. There are 3 ways and 3 goals to attain that, in my opinion. Number 1 is to avoid any consumer debt. When I'm talking about consumer debt, I just mean any credit card debt, buy now, pay later debt, or even personal loans. In order to build a strong foundation for the rest of your financial life, you need to avoid any consumer interest rate debt of over 10%. I think student loan debt is okay if the interest rate is low. You just want to make sure you have a plan to pay that off in a reasonable amount of time. The second thing to focus on in your 20s is to target a savings rate of 15 or 20% if it's possible. The key to retiring on time and even earlier is just a high savings rate. So if you're able to target a 15% savings rate of your income or more, you're going to be able to hit that target median net worth by the time you are 30. So the power of compound returns in your 20s is so powerful. So here's a small table of savings rates of 5%, 10%, 15%, and 20%. Now this assumes you make $60,000 a year. And as you can see, just by getting the average returns of the S&P 500 of 8%, by the time you're in your late 50s or early 60s, you will end up with, at minimum, a balance of $558,306. And that goes all the way up to $2.2 million. And all of these sums are actually bigger than the median net worth of someone who's actually the age of 60, which is crazy to think about. Goal number 3 in your 20s is to increase your skills or have a plan to increase your income, because I think your 20s are a really good time to experiment with a lot of jobs, hobbies, and methods to make more money. If you can take a class or certification to learn new skills to apply directly to your job, this is a really good start. I've seen people increase their salaries from 60K to 120K in a single year just by learning database management. Or similarly, you can think of ways to monetize certain expertise or advantages that you might have. So for example, if you knew a lot about building muscle, working out, and creating workout programs, there's so many ways that you can monetize that skill. You could do one-on-one personal training with people. You could become an affiliate of fitness-related products. You could start a website or newsletter that offers free knowledge and then eventually sells a product of your own. You could even start a private group or run live events for fitness-minded people to get together and learn. My point is that in your 20s, you really want to focus on how are you going to make more money eventually, or at least in your 30s. And that brings me to the decade of the 30s, because the median net worth here in your 30s is $24,508, and the average is $321,549. For the rest of this video, you will start to see that the averages get even more and more extreme, and that's because the really, really wealthy people keep skewing the average up so high that it's just going to be disconnected from the median net worth numbers. So I think the median net worth here in your 30s of $24,000 is much more doable and probably not difficult for a lot of you guys watching this video. However, it's on this channel that my goal is to have you guys overshoot this goal by so much that you are comfortably ahead of the median statistics. The uncomfortable truth is that if you just stick with the median numbers, by the time you retire, you'll have about $290,000 to $300,000 as a median net worth. And that's just not really enough to have a comfortable retirement, in my opinion. To make sure that we're on track for being comfortable in our 30s, let's stick with Fidelity's rule of thumb for now. And that means by the time you are at the end of your 30s, your recommended net worth should be 3x your salary. Based on the data, the median income in the United States at the end of your 30s is $61,970. So the recommended net worth based on Fidelity's rule of thumb is going to be $185,910. However, if you're making $100,000 per year by the time you turn 40, then I would say that goal should be $300,000, which is 3x your income. There are three big goals that I want you guys to focus on if you are in your 30s. Number one is to be debt-free except your mortgage. The idea is that in your 30s, since you're in your prime earning years, this is the decade to really start ramping up your net worth. The last thing you want at this age are credit card payments and other existing loans that are slowing the compounding of your wealth. We're still going to keep the mortgage because in our 30s, it's unlikely that most people are going to be realistically able to pay that off immediately. If you have a high mortgage rate, you might want to consider refinancing when the rates come down, and our goal of paying off the mortgage will be a target for the later decades in life. Goal number two here is to keep your lifestyle inflation low because the 30s are a decade where you start earning more money, and oftentimes what creeps up is that, well, you earn more money, you want to spend more money, so don't do that. Just make sure you avoid lifestyle inflation so that you keep more of your money for later. Number three is to have a well-stocked emergency fund. So in our 30s, you're going to have kids to take care of, a house, and possibly parents to take care of as well. All of these new responsibilities could present emergency situations in which you need liquid cash. So what happens if your kid needs an unexpected surgery, or your house suddenly needs a new appliance like a water heater, or on the flip side, you get an opportunity to invest in a business venture that requires you to have some cash. Because of this, you should consider having a well-stocked emergency fund. So if you're on the conservative side like me, I like to have up to 6 to 12 months of living expenses saved up. But the general personal finance rule of thumb is to have at least 3 to 6 months of expenses saved up in a high yield account. And if you're already there, then that's great. Now, before we get into our 40s, I want to tell you guys that I created a free 2-minute money quiz that helps you figure out where you stand financially. You just basically go to usehelm.com, you enter some basic info about yourself, and then you'll get a financial wellness score with some actionable tips. And the website I created with a friend of mine. The data is kept private, and I hope that you find it useful. I will link to it down below. All right, getting into our 40s now. The median net worth in your 40s is $76,479, and the average, I will put it up on the screen, but it's definitely going to be less relevant now. To make sure that we're on track for being comfortable by the time we retire, Fidelity recommends that you save 6x your salary by the time you hit your 50th birthday. The median income in the US at the end of your 40s is $65,000, so the recommended net worth based on Fidelity's metrics is going to be $390,000. However, once again, you should just take your income. So if you're making $100K per year by the time you're 50, dial that goal up to $600,000, which is 6x your income. The 40s are definitely going to be the most varied decade among everybody watching, and that's because I feel like at the age of 40, everyone has something different going on. You either have a family with kids and they're preparing for college, you could be single and living that Leo DiCaprio life, or you and your spouse might have moved to another country to start brand new again. So with that being said, I think there are 3 big goals in this decade of the 40s that hopefully everyone can relate to. Number 1 is to have your big expenses accounted for. That could mean paying off your house, saving for a college fund, or just simply prioritizing your retirement. You want to figure out your top 1, 2, or 3 priorities money-wise and have them accounted for in your budget. So if you determine that paying off your mortgage by the time you are 50 is a top priority for you, you want to do the math on what that might look like. Does that mean you have to make an extra mortgage payment every single year? Or does that mean you can refinance when rates come down? Or does it mean you try to bring in more income or reduce your expenses in order to put more money towards your mortgage? Having a plan for your top money priority is going to be one of the biggest goals that you can do in your 40s. The second goal is to have your retirement number in mind. So I've made so many videos on this channel on how to calculate your exact retirement number. I will leave that video down for you guys in the description below. The idea is that you want to know what withdrawal rates you're going to be comfortable with and then work backwards to figure out where your nest egg should be by the time you retire. And goal number 3 in your 40s is to have an estate plan, especially if you have dependents that rely on you and you have assets that need to be distributed. I think you should really have one of these. The major components of an estate plan are a living will as well as a healthcare power of attorney. And these will be documents that can state your preferences in case something were to happen to you. They aren't as bad to set up as so many people think. You can find templates online and then you can edit it for your own situation and then you can get it notarized. Or you can just go to a trust attorney if you prefer something like that. Personally, I don't have an estate plan yet, but that's because I don't have a family or any dependents. However, if I were to get married tomorrow and I had some kids, this is something that I would probably do first thing. And this should definitely be on your mind in the decade of the 40s. All right, getting into our 50s now. This is the big leagues, guys. So the median net worth in your 50s is $192,964 as of the latest data. The average now is over $1 million. And to make sure that we're on track for being comfortable by the time we retire, Fidelity recommends you save 8x your salary by the time you hit age 60. Now, I would say that this 8x your salary rule is very important at this level. As you guys know, that when you're in the decade of the 50s, you have retirement in less than 15 years. So when Fidelity recommends 8x, I think that is at minimum what you should be doing, but maybe closer to 10 or 12x if you can. The median income in the United States at the end of your 50s, so at the age of 60, is $62,001. So the recommended net worth based on Fidelity's metrics is going to be $496,008 by the time you hit age 60. Again, on this channel, if you are making more, so let's say you make $100,000 a year, I'd rather see you at $800,000 and upwards of $1.2 million if you can. The 50s are also a very polarizing decade, and that's because by the time you hit 50, you might be an empty nester, finally traveling the world with your spouse. You could be helping raise your grandkids while still working a full-time job, or maybe you've started a business that you've been planning for 20 years and finally you are going all in on yourself. With that being said, I think there are 3 big goals in the decade of the 50s. Goal number 1, diversify your investments and shift your asset allocation. A good portfolio mix in your 50s means that you're shifting your asset allocation more towards fixed income and bonds, or investments that are less volatile. The idea is that in your 50s, capital preservation is becoming much more of a priority because you're gonna be retiring pretty soon. I think at this point, you could even invest in some real estate, other businesses, or any other cash flowing assets that you can get your hands on. Goal number 2 is to figure out how much you actually wanna spend in retirement. If you can figure out how much you want your expected lifestyle to cost one day when you retire, you can easily back into the math of the final goal number of what you're aiming for. Once you have that number, I think that sets up a really good North Star for the next decade or 2 of your work to make sure that you hit that number ahead of retirement. Also, depending on when you take Social Security, your retirement can vary quite a bit. So if you want further watching after this video, check out my video where I go into different sizes of nest eggs and if they're enough for a comfortable retirement. I will link that below as well. Now, goal number 3 in your 50s is to start maxing out your retirement accounts, including catch-up contributions. In 2026, the 401k contribution limit is $32,500 per year for people over the age of 50. Compare that to under the age of 50, where the normal limit is $24,500. That's an extra $8,000 you can catch up with, and the IRA contribution is very similar. It's $8,600 per year when compared to the regular $7,500 per year. So take advantage of those in order to beef up your nest eggs before the decade of the 60s, which is what we're gonna get into right now. The median net worth in your 60s is $290,920, and the average I will put up on the screen, but it's around $1.576 million. To make sure that we're on track for being comfortable by the time we retire, Fidelity recommends you have 10x your salary saved by the time you hit age 65, which is around the traditional retirement age. The median income in the US at the end of your 60s is now $63,455. So based on Fidelity's metrics, we want to have $634,550 saved by the time we are 70. Personally, I would like to see 20x your income saved at this age. I know that's double what Fidelity suggests, so don't get too scared, but I think you can do it if you're diligent about your finances throughout your life. Having 20x your income saved makes it so much easier to hit your nest egg amount, and that's just plain math. Most withdrawal rate rules are between 4 to 4.7%. This usually means you're gonna have about 20 to 25x your annual expenses saved up in a nest egg. But most retirees end up spending way less in retirement because their major expenses disappear. They usually don't have to pay for a mortgage, the kids are financially independent, and they're no longer needing to save 15 to 20% of their income. In some cases, they've downsized their lifestyle as well to match their needs instead of trying to keep up with appearances. All right, so I think that the main goals at the age of 60 are the following. Number 1, finalize your retirement. There's no more guessing about how much you'll need. You should know exactly how much you'll need, how close you are to getting there, and have a really solid understanding of your financials. Ideally, at the age of 65 or 67 years old, you're retiring, you're taking Social Security, and you can enjoy the rest of your life stress-free. Goal number 2, focus on capital preservation. Once you're retired, it's all about making that money stretch as long as it can. And lastly, goal number 3 is to have your house completely paid off. I know that this is self-explanatory, but I feel like if you bought your house in your 30s, your 30-year mortgage should finally be finishing up if it's not already paid off yet. We're gonna be walking through how much money you should have saved by every decade. So whether you're in your 20s, 30s, 40s, or even nearing retirement, we'll have those numbers for you, as well as the major goals for every decade. I will also share with you the median and average net worth for someone your age based on the data that we have from Fidelity, Empower, and the Federal Reserve. There will also be timestamps and chapter markers, so if you just want to skip around to the decade that applies to you the most, you can do so. All right, so let's get started with the decade of the 20s. So in your 20s, you're likely graduating school. You still have a lot of student debt, and therefore your savings as well as your median net worth aren't going to be at its highest point in your life. In fact, it'll probably be the lowest it will ever be, and a lot of people in their 20s will have a negative net worth as they try to climb out of the student debt balance that they might have. The median net worth of someone in their 20s is $6,980. So remember guys, the median value in this case is going to be the exact middle point of all the net worths for this age decade range. So if you took all of them and you arranged them in order, this would be the middle value. There's going to be some outliers at either end. So there's going to be some people that have a ton of money in the age of their 20s and some that have a huge negative net worth. But the idea is that half the population will have less than the median and half the population will have more than the median. And when it comes to figuring out what your net worth should be by age, I think we should stick to the median because that's a better representation than what the average net worth is, because the average net worth is going to be heavily influenced by those with really high net worths at the top of the spectrum. As you can see, the average net worth is $99,272 for someone in their 20s according to Empower, and that's really high when you compare it to the median and probably unrealistic. In terms of savings, the target number that you should have saved by the end of your 20s, so when you hit the age of 30, is 1x your salary for retirement. Fidelity recommends this number in order to stay on track for retirement by the age of 67. So let's say at the age of 29 or 30, you're making $75,000 a year. That means you should have at least $75,000 saved in all of your accounts. So that includes your retirement accounts, your brokerage accounts, and also your savings accounts. If you are looking to retire earlier than the age of 67, then you want to check out my video on the channel. I have an exact dedicated video on how to figure that out because the math will change considerably. In terms of goals to hit in your 20s, I think there are 4 big ones. So the first one is going to be no consumer debt. And this is one that I harp on a lot, but if you have any high interest rate debt or credit card debt, you want to kill that off immediately. And the reason is simple. It really slows down your wealth compounding. So anytime you do have that, you want to get rid of it as quickly as possible. But I think student loans are still okay to have, especially in your 20s, because it's usually a large balance and the interest rate is a lot lower. The second goal to hit in your 20s is to understand your spending. So by knowing how much money is coming in versus going out on any given month, you're going to be ahead of most of the people in their 20s because you're going to have more of a picture of your finances than other people. The third goal is to have a plan to make more income eventually, especially in your 30s and your 40s. Now in your 20s, it's not imperative that you are raking it in, but I think it is important that you are experimenting with a lot of different things. If you're able to find a role, a skill, or a career that you particularly enjoy, then by the time you're in your 30s and your 40s and you've honed in on that skill, you could be making a lot more money then on. And finally, the last goal in your 20s is to start investing, and good investing starts with a good solid financial foundation. So make sure you have at least an emergency fund stocked with 3 to 6 months of living expenses. After you have that filled up, I'd probably start looking at investing through tax advantaged accounts like your 401k, your IRA, or the Roth IRA. In my opinion, if you're in your decade of the 20s and you have no debt as well as some savings, then you're going to be ahead of most people at this age bracket. Now, if you do have a median net worth higher than $6,980, then you're going to be doing much better than at least half the population. That brings me to the decade of the 30s. Now, in your 30s, you're likely hitting your stride when it comes to your career. You might be starting a family, you might be getting married soon, and therefore you have a lot of big expenses coming up, such as paying for that said wedding, buying a house, or even, buying your favorite Charizard card that's a PSA 10 and costs over 250 grand. All kidding aside though, the median net worth of someone in their 30s is $34,691. And if you watched my old video from 2021 on this exact topic, you'll know that that's a lot higher than the 2021 video. And that's because the median net worth has really increased in the last few years. So according to the Federal Reserve Survey of Consumer Finances, quote, between 2019 and 2022, real median net worth surged 37% and real mean net worth increased 23%. Indeed, the 2019 to 2022 growth in median net worth was the largest 3-year increase over the history of the modern SCF, more than double the next largest one on record. Now, a huge reason why net worth has really skyrocketed the past few years is due to asset prices. So from 2019 to 2022, as you may or may not know, the stock market has been absolutely ripping, as well as the fact that home prices these days are 25% higher than they used to be back in 2019. We also have more dollars circulating in the economy due to all the money that was printed during the pandemic pandemic, and so therefore we have more dollars chasing the same amount of goods, aka inflation, so asset prices are going up. It's important to note that if you don't have the median net worth of $34,691 or you're still in debt in your 30s, it's not time to panic. In your 30s, it's still early enough where that if you start taking actionable steps today to crush that debt or to start saving more, that you could be well beyond the median net worth as well as the average savings rate for most people by the time you're 65. The goal of today's video is to show you how most people are doing in the United States, and if you aren't there financially just yet, I'm glad you found this video, and we are going to teach you those steps in order to get you there and beyond in this video and in future videos on this channel. So the amount that you should have saved by the end of your 30s, aka when you hit the age of 40, is going to be 3x your salary saved for retirement. Now, according to the Bureau of Labor Statistics, the average annual income of someone by the age of 40 in the United States is $62,000. That means by the age of 40, you should have 3 times that saved in retirement accounts, taxable brokerage accounts, savings accounts, etc. So 3 times $62,000 is $186,000. By doing so and using a retirement calculator from NerdWallet here, we can assume with investments that you should be able to get to $2.11 million by the time you're the age of 67, which is pretty darn good. In my opinion, I think there are a few goals in your 30s that you should be really hitting. Number 1, you should be systematically saving and investing 15 to 20% of your gross income. And if you're able to do this, then the math really just shows you how powerful this is. Let's say you could only save 5% of a $60,000 salary, so $3,000 a year into the S&P 500. Even at $3,000 a year, if you get the average returns of the S&P 500 at 8%, by the time you're age 65, you're still gonna end up with a balance of over $600,000. Now, here's a spoiler, but the median net worth of someone in their 60s is $454,000 in America. So literally, if you start at the age of 30 and you invest $250 a month into the market, which is $3,000 a year, you could be well over the median net worth by the time you're in your 60s. Goal number 2 in your 30s is to be completely out of debt, excluding your mortgage, of course, by the time you're age 40. The idea here is that in your 30s, these are your prime earning years, so you really want to start ramping up that net worth. And the way that you do that is you keep your lifestyle the exact same while your income goes up, and therefore you're going to have more money every single paycheck to invest and also pay off debt. The last thing you want in your 30s is to have so many existing credit card payments or buy now, pay later payments or any high interest rate payments that are slowing down your wealth building. Goal number 3 in your 30s, since you're going to be making more money, you probably have more obligations as well, but you want to avoid spending too much money via lifestyle inflation. One of the most famous quotes in the book Millionaire Next Door is the following. So quote, "Great offense and poor defense translate into the underaccumulation of wealth. And the foundation stone of wealth accumulation is defense. And this defense should be anchored by budgeting and planning." So what he's saying here is that even if you have a strong offense, aka you're making a lot of money, if you have a poor defense, you are going to be an underaccumulator of wealth. So defense in this case means spending reasonably. And so if you have that good defense set up, then you're going to be just fine. Goal number 4 in your 30s is to test your reaction time to see how fast you can subscribe to this channel. So I just did it myself and it took me less than 0.1 seconds. Okay, now that you've done that, let's talk about the age of the 40s. So the average net worth of someone in their 40s, now this is average again, is starting to get pretty crazy. It's $713,796. Now this makes sense to me because in your 40s, you're gonna have those people that are really making a crap ton of money, especially at the higher end of the spectrum. So they are really skewing this average all the way up. But we should still be focused on the median net worth at this age. And the median net worth of someone in their 40s is $126,881. That's a much more realistic number to wrap our heads around. And I think if you are in your 20s or your 30s right now, you should be able to blow way past this median net worth number, especially if you start right now. For example, if you start investing $5,000 per year at the age of 25, by the time you are age 40, so you're not even in the 40s just yet, you are just age 40, your investment will be $162,000, which is more than the median net worth. Fidelity recommends that in your 40s, before you hit the age of 50, you should have at least 6 times your salary saved for retirement. Now, 6x your salary saved for retirement is double that of what the previous requirement was at the end of your 30s. And so you can see that as we move up in age, your savings targets will also move up and up and up. In your 40s, I think there should be a few goals that you should be targeting. So the first one is that you should have your retirement number in mind. You're probably more than 2 decades away from retirement at this point, but the idea is still that you should be able to figure out how much you need to live off in your retirement and then therefore work backwards to figure out what retirement number you need to get to by the time you are age 65 or 67. A good rule of thumb is that you want to try to live off of 3 to 4% of your investable assets every single year in retirement. So I always like to use the $1 million benchmark here as an example. So if you have $1 million invested and you withdraw 4% per year, that means you're able to withdraw $40,000 $40,000 per year in retirement. The idea here is that 4% or $40,000 per year is a reasonable amount to withdraw because your investments are hopefully gaining you at least 8 to 10% on average every single year. So that means you're at least earning more than you are actually spending. Goal number 2 in your 40s is to have all of your big expenses accounted for. So if that means paying off your house or saving for a college fund, you should know exactly what those big expenses are, and you should have a plan and priorities for all of those. Goal number 3 in your 40s, at this point, I think you should have all of your financial bases under control as well. So that means you should have an excellent credit score, an estate plan if you think you need it, $0 in debt except maybe a mortgage, and a plan for the next 20 years moving forward. All right, let's talk about the age of the 50s now. So when you're in your 50s, the average and median net worths really start to get crazy. The median net worth of someone who is in their 50s is $292,085. The amount that experts think that you should have saved by the time you are age 60, so the end of your 50s, is 8x your salary saved for retirement. So if you know you've been making $60,000 a year for your entire life, for example, if you hit the age of 60, then you want to have 8x saved, so that's $480,000. Personally, I think that's a healthy number to aspire to, and 8x your salary saved by the time you are in your 60s is going to be a somewhat reasonable number. Now, 17% of you guys watching are between the age of 45 and 65, so if that is or that happens to be you, please let me know down in the comments how much you have saved and if you think this is reasonable. I think there are 3 big goals here to accomplish in your 50s. So number 1, if you have a mortgage, it's likely that your 30-year mortgage is coming up soon, especially if you got your house in your late 20s or early 30s. So I would prioritize paying off that debt and living a life debt-free. Number 2, you can diversify your investments even further. So perhaps that's picking up some real estate, investing in some businesses, or just shifting your portfolio, your retirement portfolio, towards more conservative assets rather than riskier assets. And number 3, you should know how much you want to spend in retirement every single year. It's likely that your kids are going to be out of the house soon. So if they are out of the house, then you have a better sense of how much you are spending on a monthly and yearly basis. There is an 80% rule by Fidelity that can be a good guideline for how much you want to be spending in retirement. It states that whatever you're making on an annual basis, plan to spend around 80% of that in retirement every single year. So if your salary is $100,000 per year, you want to plan to spend around $80,000 every year in retirement. And here's a great table from Fidelity that has good suggestions on what rule you should be sticking to based on your income range. For most people though, we want to stick between the range of 55 to 80%. Now, obviously this is a little bit lifestyle dependent, but still it's a good guideline to look at. All right, guys, we've made it to the final frontier, the age of your 60s. The median net worth of someone in their 60s is $454,489. And by the time you're 67 or the retirement age, you should aim to have at least 10x your salary saved for retirement. The average income of somebody in America at the age of 60 is roughly $63,500. So that means if you want 10x that salary saved by the time you're 67, you should have at least $635,000 saved up. Now, if you're going for the $1 million at retirement or even more, then you're gonna at least need minimum 15 times the national average salary. And if you want 2 million, that's gonna be 30 times. I think the main goals at age 60 are the following. So number 1, it's very similar to the number 1 goal of the decade of the 50s, and that's to have your house paid off. This should be self-explanatory, but I feel like if you are in your 60s and you still have a mortgage, that's not maybe the best financial place to be at. You should really be focusing on retirement and looking ahead instead. Goal number 2, if you have dependents that rely on you, then the assets should be accounted for, and you should probably have an estate plan. The major components of an estate plan are the living will as well as the healthcare power of attorney. At minimum, you want to have these documents so that you can state your preferences in case something were to happen to you. Another benefit of an estate plan is that it allows you to designate a legal guardian for any minor children you might have, ensuring that they're going to be cared for by someone that you trust. Goal number 3 is that you have your retirement teed up. There's no more guessing in how much more money you're going to need for retirement. You know exactly how much you need, how close you are to getting there, and you have a really solid understanding of your own financials. All right, guys, and that concludes the age of the 60s. Let me know how much you have saved in the comments as well as your age down below. It is my favorite time of the year, 401k balances by age. Now this year, Vanguard came out with their latest flagship report on how America saves in late June. And in it, they talk about the retirement trends of over 5 million Vanguard plan participants. I'd say that's a pretty good representation of the majority of Americans. So in today's video, we'll cover how much you should have saved in your 401k based on the latest data. We'll talk about what has changed from previous years, if any, and we'll see how you stack up against people in every age bracket. Starting with the first age group, which is anyone younger than the age of 25. So people in this age range have just started working. They probably just started their 401k. And what's really surprising is that this year, the average 401k balance for this age group is actually down year over year. Last year, it was $7,351 was the average, but this year it's $6,899. The median balance is $1,948, down from $2,816 from last year. However, the 1948 number is still bigger than it was 2 years ago. Now, in terms of why the account balances are down across the board in this group, Vanguard noted that only 54% of workers under the age of 25 participate in their employer's plan. That's the lowest participation rate of any age group, and that in this age group, there is a high turnover for work in general, since people are just usually starting their careers. It's hard to take the data under 25 very seriously because of these factors, as well as the fact that most people under the age of 25, they just haven't had a lot of time and a lot of years to contribute to their 401ks yet, which means that the sample size, in my opinion, just hasn't been big enough. Now, what is surprising though, that the market has been up quite a bit from 2024. So theoretically, we should be seeing a positive gain for average and median balances across the board for people who have been invested for a longer period of time, which I will touch upon shortly. The report confirms that 2024 was an excellent year for stock market performance, with the S&P 500 returning approximately 23 to 24% last calendar year alone. You can see here that the percentage of people with at least a positive gain was 93%. And if we actually look at the change in account balances, this chart right here, we can see that 47% of plan participants had their portfolio return 1 to 25% from 2023 to 2024. Also, 21% of people achieved a return of 26 to 50%, which is also pretty crazy. The average contribution rate of someone who is under the age of 25 is between 8.2 and 9.9%. That means if someone is earning $50,000 per year, they are contributing somewhere in the range of $4,100 to just shy of $5,000 per year to their 401k balances. Now, this figure does include the employer match. And as to why I said between 8.2 and 9.9%, the reason has to do with voluntary versus automatic enrollment. And this is something that I find pretty fascinating. Automatic enrollment just means that whenever employees are hired, they are automatically signed up for their company's 401k plan when they become eligible, rather than having to basically actively choose to join. A voluntary enrollment is kind of like the opposite. It just means when you join your company, they'll ask you if you want to join the 401k plan, and at that point, you can either confirm or deny it. It's a subtle difference, but the mere act of it being completely automatic increases the participation rate as well as the contribution rate. Vanguard says that there's a 94% participation rate in auto enrollment plans versus 64% in voluntary plans. That means there's a 30% difference for how many people contribute, just depending on how their employer sets up their plans. It's also important to note that automatic enrollment plans often include automatic annual increases as well, which means that you don't really need to think about contributing more money as time goes on. So that means if you're young or joining a new company, if your employer does not offer automatic enrollment, you should make sure you enroll, because the effect it has on your future balances is quite magnified. You can see in this bar chart that while new employees in automatic enrollment start with lower balances, the gap actually reverses quite quickly. By years 2 and 3, automatic enrollment participants have higher balances, $20,806 compared to the $18,585. Then by year 10 and onwards, the gap actually gets even bigger and bigger. This happens because automatic enrollment people generally save more, they save consistently, and have higher contribution rates as a whole. They basically don't have to think about it. They're also less likely to stop contributing once they've been enrolled, which shows you just how powerful your own behavior is when it comes to growing your retirement accounts. Anyways, enough with that. I think the main thing to focus on under 25, if you are under the age of 25, is to start a 401k. You make contributions to it, take advantage of any matching, and make sure that all of your basically foundational personal finance items are in check. That means you don't have any high interest rate debt. Perhaps you're building a budget, perhaps you're building your emergency fund. If you can nail those basics, then you're perfectly set up for the next decade of the ages of 25 to 34, because that's where those habits will really pay off. Okay, the average 401k balance in the age group of 25 to 34 is now $42,640, and the median is $16,255. The voluntary contribution rate in this group is 10%, and the automatic is 11.7%, so it is slightly higher than that of the under 25 bucket. Again, this does include employer matching. Now, the biggest tip I have for the ages of 25 to 34 is that you stay away from lifestyle inflation and you try to increase your savings rate by as much as you can. It's at this age range that you're really solidifying your personal finance habits. So if you can get into the habit of saving more than you think is needed, you will likely be able to retire early if you're able to stay consistent with it. If you can have a stretch goal to get your contribution rate above 15% or maybe even 20% at this age, I think that's a really good benchmark to look for. At a 20% savings rate, it generally takes about 37 working years until retirement. That means if you're the age of 26 right now and you save 20% per year, generally speaking, you can retire when you're 63. And the reason is as you cut your spending, you need less money to live on. Reducing your spend means that number one, you will increase the amount of money you have left over every month. And number two, it decreases the amount you need every month for the rest of your life. That's why I think so many people online and as well as very wealthy people, they preach living below your means because it means it'll give you a lot more freedom than you might think. Of course, increasing your income is really nice too, because at that point you can increase the gap between what you make and what you spend, provided that you stay away from lifestyle inflation. All right, my last tip at this age range I have for you guys is to start planning for bigger purchases in the future. It's likely at this age range that you're starting to either get married or you're thinking about it, you're buying a house or you're thinking about it, or perhaps you just have some other big purchases you personally want to make. The next age range, though, is where you'll start to feel financially pulled in many directions. So we're going to talk about that now, and that's the age range of 35 to 44. The average 401k balance at this age range is now $103,552, and the median is $39,958. The average contribution rate ranges from 10.6 to 12.2%, so a little bit higher than the last age range as well. Now, between the ages of 35 to 44, this means you probably have 20 to 30 years until retirement at a conventional age, unless you're trying to retire early. It's probably at this point you want to start thinking about if that is something you really want to go for and if it's reasonable or not, the early retirement, of course. This is going to be highly dependent on your personal situation, so if you have a double income household with no kids, there might be a chance you can retire early if you just sock away all your extra earnings during this time. On the flip side, if you just lost your job, you got divorced, and you're trying to be a single parent, your priority might just be survival until you can retire at a conventional age and then have Social Security kick in. One good goal to have at this age range is to have around 3 to 4 times your annual salary saved for retirement by the time you're 44. So that means if you're making $70,000 a year at 44 years old, you want to try to hit a retirement savings goal of between $210,000 and $280,000. The big challenge at this age range, I think, is juggling financial responsibilities such as getting married, buying a house, having a kid, dealing with the death of a loved one, and still working and trying to maximize your earning potential while you're still deep in your career. Another milestone you can shoot for by the time you're the age of 44 is to have $0 in debt. Now, the exception here, though, can be your mortgage. That means we're trying to aim for $0 in consumer debt when it comes to credit cards, as well as paying off any debt related to student loans. And my personal opinion is that you should have your cars paid off as well. The idea here is that in your 30s and early 40s, these are some of your prime earning years. This is the decade to really start ramping up your net worth. The last thing you want are credit card payments and other existing loans that are slowing your compounding of your said wealth. So I just want to make sure you're able to build your wealth in a correct way. And I think having $0 in debt is also going to give you like a ton of peace of mind. And the next goal I have for you guys at the ages of 35 to 44 is to try to increase your contribution rate to 15 to 20% if you can swing it. I already talked about that in the last age range, but if you haven't done it yet, I think this is the time to do it because it's going to help a lot when it comes to building your retirement nest egg. All right, as we move into the ages of 45 to 54, this is where the retirement savings game gets even more serious. And frankly, we're going to start to see if the groundwork that you put in your earlier years will start to pay off. By the ages of 45 to 54, the average 401k balance is now $188,643, and the median here is $67,796. The averages are starting to get really skewed at this age because more people are making more money in their 30s and 40s, and so therefore the higher end of the range tends to skew things upwards. The average contribution rate at this age sits between 11.4 and 12.9%, which is crazy because it really hasn't changed that much since the last age bracket. It's gone up a little bit, but I don't think it's gone up enough. I think that just shows you that most people aren't really increasing their contribution rates aggressively as they move throughout life. But I think that on our channel, the community here should be aiming to save more than the average. and that way we can continue to stay on track and even perhaps blow expectations out of the water. Fidelity suggests that by the age of 55, you should have around roughly 7 times your annual salary saved for retirement. So that means, let's say you're earning a $100,000 salary at the age of 55, you should have about $700,000 at least stashed away for retirement, which is clearly much higher than the average balance at this age range. I think there are some big goals here from the mid 40s to early 50s. Number one, I think you should pay off your mortgage debt if you're able to get rid of this debt. It's a really good thing because you free up so much cash flow to start investing even more money into retirement, or perhaps you just live life a little bit more freely. Number two, you should know approximately what your annual spending is, because we want to use this annual spending rate in retirement, because we're going to use that number to figure out and project out what we'll actually need in retirement in terms of our total balance. According to Fidelity, here's their table that they recommend. If you make less than $50,000 per year, your estimated retirement income replacement ratio is 80%. So that means you should plan to spend about $40,000 per year in retirement. The more money you make, the smaller your estimated retirement income replacement ratio is, and that's because Fidelity is assuming that when you make more money, you will also live off a smaller percentage of it. Now, I don't know if that's the best advice, but they had to come up with a rubric for a very large and broad population, so that's what they landed on. The better guideline, in my opinion, is just to figure out what your annual spending is, especially pre-retirement, and discount it by 20% as a conservative estimate. That means if you're spending $100,000 per year in your 50s, you probably could live off of $80,000 or 20% less than what you are spending. I think a good exercise before you retire is to track your normal expenses on any given month or period of 3 months, and that way it gives you a good gauge for how much you're probably going to be spending in retirement and later on in life. The third goal at this age range is to have an estate plan in place if you have dependents that rely on you. That way, if you have assets to be distributed in case something were to happen to you, at least things are in written format and the instructions are clear. This is more just like a in case something happens type of goal, but I think it's still good to establish at this age range, or maybe even a little bit before. Now, if you've tackled some of these goals in your late 40s and early 50s, such as paying off your mortgage, tracking your spending, and getting that estate plan in place, then the next age bracket of 55 to 64, this becomes the final countdown to retirement, and I think the stakes rise a little bit. At the ages of 55 to 64, the average 401k balance in America is now $271,300, and the median is $95,642. The average contribution rate sits between 12.8 and 14.4%. Now, the balances for this age group didn't really change too much from the previous year because most people in this group are less exposed to equities in the market. So even though the market performed really well, it might have had a smaller effect on this age group in particular, since retirement planning is the sole focus now and there's usually less stocks in those portfolios. By the time you're the age of 65, you should aim to have 10 times your salary saved before retirement, according to Fidelity. Now, these balances, at least according to Vanguard, are not the best, or you hope that the people in the ages of 55 to 64 have more than just their 401k, because if the average balance is only $271,000 and that's all you have to retire off of, it's unlikely that you would be able to retire comfortably. In any case, I would recommend you watch some of my videos on safe withdrawal rates if you are in this age range and concerned whether or not you can retire on time or not. And if you are younger than the ages of 55 to 64 and you're watching this part for fun, you may really want to take the initiative now and really focus on getting your contribution rates up while you still can. The biggest thing that moves the needle when it comes to 401k, retirement savings, and your future nest egg is literally your savings rate. So I think if you're young, try to increase your savings rate as much as you can, the better off you will be. The last age range today is the 65 and up age range. Now, I don't really have too many tips for you guys at this age range because at this point, you're probably in retirement. But I did want to share that the average 401k balance here is $299,942, and the median is close to $100,000. By this time, you should have figured out how much you needed to retire and have most of your financial planning out of the way. We're walking through the average income by age, and I'm also going to show you exactly where the bottom 25%, middle 50%, 75th, 90th, and top 1% fall at every single decade of life. This is all according to the most recent data for the end of 2025 and beginning of 2026, and I also will be sharing 3 goals for every age range that can actually move the needle on your income and your net worth. So whether you're in your 20s, 40s, 60s, or anything in between, I have something for you in this video. And as always, timestamps will be below. So if you just like to skip below to your age and see how you stack up, you can do that. All right, starting with the 20s here, you can see that the incomes at age 20 versus 29, there's actually a huge difference. That's because at the age of 20, you are still in the education phase of your life, or perhaps you're just starting your career, versus at the age of 29, that's a probably better representation of this age bracket of someone who's basically a young professional. Now, the average income, as you can see at the age of 29, is $73,903. However, I think that the average income can be a little bit misleading at times. That's because averages are calculated by adding up everyone's income and dividing it by the number of people, but a few very high or very low incomes can pull the average away from what most people actually earn. So in that case, I think that a better representation is probably the median income for most of America. I would say though, if you are living on the coasts in a high cost of living area such as San Francisco or New York, you might want to use the 75th percentile of income as a better benchmark. That's because I feel like those incomes in those specific regions are usually a lot higher than just the median, so it's probably better to compare yourself to your cohort, and your cohort is probably in the 75th percentile income. Either way though, you can see that most people in their 20s will be earning less than $100,000 per year, and it's only when you hit the top 10% of incomes in the nation that you are well in the six-figure mark. Also, $396,000 for the top 1% is pretty crazy in your 20s. I think the incomes here are probably going to be mostly comprised of people doing tech, so software engineers in tech at like one of these big AI firms. Maybe you work at a hedge fund, a private equity shop, or maybe you're an investment banker. Or just maybe you're just an entrepreneur that just makes a lot of money. There are 3 top goals that you should be achieving in your 20s, and the first is to build basic money habits that form a strong foundation. I'm not expecting you to save tens of thousands of dollars in your 20s, but I think that you should have some sort of structure for your finances. So that means automating a small amount of your regular paycheck into a savings or investment account, starting your first retirement accounts like your 401k or your IRA, and also just having a basic level of tracking for your spending so that you know where most of your money is going. Goal number 2 in your 20s is to keep your fixed expenses as light as possible. So if you can stay home and live with your parents for an extended period of time in your 20s, I think that's even better because you're going to build up a really good base of money before you move out. If you don't have that luxury, then perhaps just make sure that you aren't living too lavishly, because these days, the statistics are pretty crazy. The average car payment is $766 in the United States, so make sure that you are well below that. And the average person spends about 32.8% of their income on rent. So if you can stay below that number, I think that's even better too. My last stat for you guys is that the average person also spends about $1,080 per year on subscriptions. So if you can make sure that you're not going too overboard in any of these 3 categories, transportation, housing, fixed expenses like subscriptions, then you're going to be a lot better off in your 30s. And goal number 3 in your 20s is to prioritize building your skills so that you can increase your income later. That means you might want to job hop early when it can make a big difference and it makes sense for you, or you want to build skills and get educational credentials that can increase your pay. You can also just take on more responsibility at work. I know that sounds really basic, but a lot of people are afraid of that because they don't want more work for themselves. However, I think that taking on more responsibility will increase your skills and then create more value for you in your long-term career. In your 20s, your income curve is going to matter way more than your current bank balance, and I would encourage you to even maybe take some risks in order to get more experience and build your skills up. All right, let's go to the next decade of the 30s now. I'm going to use the age of 35 here for our data reference since it's right in the middle of the decade, and you can see that the average income is now $82,950 and the median sits at $60K exactly. The top 10% is now at $167K per year, and the top 1%, well, they are nearing the highest federal tax bracket. So fun fact is that the highest federal tax bracket is now for incomes greater than $640,600 for the year of 2026. Now, ironically, as your income is increasing in your 30s, this is the decade where people lose the most ground financially. That's because their spending catches up too quickly. You usually start a family in your 30s, you're having big life events like a wedding or you're buying a house, and you just might find yourself a little bit stretched thin in many different directions. So I think there are 3 goals in your 30s as well. So goal number 1 in your 30s is to really make sure you avoid this lifestyle creep. It's tempting to upgrade your lifestyle as your income grows, but if you're overspending on cars, homes, or luxury items, this can quickly slow down your progress towards financial freedom. A good rule of thumb when it comes to increasing your lifestyle is to think about the costs you're debating over a longer term time horizon. If you want to drive a nicer car, think about how much more that will cost you, not just this year, but perhaps over the next 5 or 10 years total. I find that when I do this exercise, it really makes me think twice about that expensive upgrade. Another great life-changing rule is to save half of every single raise that you get. So for example, if you get a raise from $100K per year to say $110,000 per year, you now have $10K more of gross income to work with, and you want to save half of that and then freely spend the rest. That way, every time you get a raise, you're at least making saving a habit, and then not only are you going to be saving more, you're also increasing your lifestyle, which is very nice to do, but just not by that much. Goal number 2 is to be completely debt debt-free of everything except for mortgage debt by the time you're 40. The idea is that in your 30s, this is one of the prime earning decades to really start ramping up your net worth. The last thing you want are credit card payments and other existing loans that are slowing your compounding of wealth. And goal number 3 is that you should be systematically saving and investing 15 to 20% of your income if you can afford it. Even if you only can save and invest about 5% on a $60,000 salary, that still means you're investing $3,000 every single year. Even at $3,000 a year, if you get the average returns of the S&P 500 of 8%, by the time you're age 65, you're still going to end up with an ending balance of over $600,000. All right, let's get into our 40s now. You can see that the average income in your 40s is now $95,613. And the median is $67,144. That means the median income has gone up roughly 11% since the decade before. As you get older, you earn more, and now you can also see that the 75th percentile earns $117,000 compared to $100,000 the decade before. The top 10% and 1% are still increasing their incomes, of course, as well. In your 40s, I think there are a few goals that you should be shooting for with this extra income, especially as this is one of the biggest peak earning decades of your life. Number 1, you want to start planning for your ultimate retirement number. So you're probably still about 20 years away from retirement, but it's really good to figure out now what maybe your nest egg will need to look like in order to support your life in retirement at a later age. A good rule of thumb on this channel is that you want to live off of 4 to 4.5% of your total investable assets during retirement every single year. So if you were to use $1 million as a benchmark and you had that invested in the market, the idea is that you can withdraw 4% of that $1 million every single year, and the market returns should at least keep your balance growing or at least flat while you withdraw from it. That way, it gives you the highest probability of still having money throughout your entire retirement. Goal number 2 is to make sure your income covers your major expenses before they ever actually arrive. That means you could work on paying off your house, saving for a college fund, paying for home repairs, or taking care of your aging parents. Anything that you consider a major expense that is coming up, you should be using your income to plan accordingly for it. And goal number 3 in your 40s is to use these peak earning years to reduce any major debts that you still have. In our 30s, we want to be debt-free besides our mortgage. Well, in your 40s, that's still the case, but now you want to start figuring out how you can be completely debt-free by the time you turn 50. The less financial pressure you carry into your 50s, the more freedom that you will gain. And I think that in your 50s, it's not about grinding more and more, but perhaps maybe you can dial it back a bit. So in your 40s, you want to set yourself up for your 50s so that in your 50s, you can choose the work and the projects that you care about and have the ability to say no to a lot of things. All right, now that we've reached the decade of the 50s, you can see that the average income is now $90,986 and the median is $63,350. The median income actually dropped since the age of 45, and as more people step back from work, the numbers are going to reflect that. Now, a fun fact here is that the median income actually peaks at the age of 52 at $70K, and then it goes down from there until the age of 62 when it starts climbing back up again, but we're going to talk about that in a little bit. You can see that even the top 90th and top 1% incomes went down as well in this decade compared to the decade before. So knowing this data, how should it affect our goals going into this decade of the ages of 50 to 59? So goal number 1 is to diversify your investments. Instead of putting everything into the S&P 500 or the NASDAQ, your investments should now be more of a balanced mix. In your 50s, that means you allocate perhaps some money to lower risk assets such as bonds and fixed income, treasuries, cash, and CDs. In the 50s, I don't think it's about getting huge returns anymore, but more capital preservation. You just want to make sure you're not making a life-changing mistake of investing into something and you lose all your money. Goal number 2 in your 50s is to know how much you want to spend in retirement. It's likely that your kids are out of the house now, so you can get a really good sense of how much you're spending on a monthly and a yearly basis so that you can plan even further. Fidelity likes to recommend the 80% rule, which states that you should plan to spend about 80% of your salary in retirement. So here is their table on the screen if you'd like to reference that. And goal number 3 in your 50s is to start maxing out your retirement accounts, including catch-up contributions. For example, in 2026, the 401k contribution limit is now up to $32,500 per year for people over the age of 50. Compare that to the under the age of 50 number where the normal limit is $24,500. That's an extra $8K that you can catch up with every single year. The IRA and Roth IRA contribution limits are now $8,600 per year. Compare that to the under the age of 50, where the regular limit is $7,500 per year. So you want to take advantage of those, and then you want to finalize everything else financially going into your 60s, which means that if you can fill in any gaps between what you need and what you currently have saved, that's going to help a ton in your 60s as well. All right, so we've been talking about the decade of the 60s for a while, so let's talk about their income numbers. We can see that around the age of retirement of age 65, the median income coincidentally is also $70,001. If you remember, it's also the same median income at the age of 52, but at age 65, it goes back up again to $70,001. The average income is $101,000, and the 75th, 90th, and top 1% have gone back up by a little bit again. I think that this is happening because if you're 65 and retired, you aren't being counted towards these income numbers. So these numbers are more of a reflection of the last man standing in a way. It is pretty fascinating to see that. So if you have any theories on why you think this is happening, please leave them in the comments. Now, in your 60s, I think there are 3 definitive goals. Number 1, definitely have your house paid off. This is self-explanatory, but I feel like if you bought your house in your 30s, your 30-year mortgage should be finally finishing up now, if not already been paid off already. Goal number 2 in your 60s is that if you have dependents that rely on you, you should have an estate plan. Not having a proper estate plan can cause huge headaches for you and your family if you unexpectedly pass, and you want to be sure that you can transfer any assets that you have to your loved ones in a seamless way without any arguments and full instructions. And the third goal is very simple. It's that your retirement is teed up already. There's no more guessing about how much money you're gonna need. You know exactly how much you'll need, how close you are to getting there, and you have a really solid understanding of your financials. Ideally at 65, you can retire very comfortably. You can ride off into the sunset into a very happy place. Maybe you can go traveling, check out some museums, eat sushi, whatever you might like. We'll be covering what major money milestones you should aim to accomplish in your 20s. The idea for this video came after a friend of mine, Kayla, who is 25 years old, wanted to know what else she needed to get done in her 20s to achieve financial freedom. So I am 34 right now, and I learned a great deal about personal finance, budgeting, and investing in my 20s. In fact, I was even a financial advisor for Bank of America Merrill Lynch when I was 25, and I attribute a lot of my investment knowledge to that experience. Now, when you're starting off at the age of 20, I feel like the college and education system here just don't really teach you that much when it comes to managing the adult world of finance. So this video is meant to be a one-stop shop for all of your financial needs to get a solid financial foundation going. I hope that you share this video with a friend who might need it, and then it becomes a resource for you in the future that you can reference at any point in time. So with that being said, make sure to hit the like button on this video and let's get started. This video first covers what it takes to build a financial foundation in chronological order, and that means we need to start with the first financial milestone, which is to pay off debt or stay out of student debt. So chances are, if you graduate college, you're likely going to have some student loans, and you might even have some credit card debt. The average student loan debt in America is $39,000, and oftentimes, if you're going to a 4-year institution or even a 2-year institution after transferring from community college, you'll likely take on some student loan debt. One of your first major milestones in your 20s is to figure out a plan to pay off this debt. Usually federal student loan interest rates are between 4 and 6%, and you're gonna have many of your friends probably tell you that you can get an average of 8% on your money by being invested in the market. So they're gonna say things like, why are you paying off your debt when you can just invest it and get a higher return? While you can earn 8% in the market, many people often forget that you can also lose that money as well if the market doesn't do as hot. When it comes to paying off student loan debt, try to prioritize it over investing, because at least you know it's going to give you a guaranteed 46% return on your money. And the sooner you get rid of student loan debt, the quicker that weight is going to be lifted off of your shoulders and you can afford to take on more risk in life. The point of paying off debt is more so that you can afford to take these risks in your 20s uninhibited. When you're debt free, you might take a chance on a startup or a risky business venture that could net you maybe a 50x return in the future. But when you're burdened with debt, you're basically a slave to that debt and you have to continually service it, which means that you might have to compromise your best learning years by being forced to take a job you might not enjoy. If you're at the point in your life where you still haven't entered college yet, you may want to reconsider if a 4-year institution is actually worth it for you, because taking on massive student debt in the long run is going to be hard. Also, you can just go to a community college for 2 years and then transfer into that same 4-year institution your junior year. By the time you graduate, it's all the same anyway. No one will really care that you went to a community college your first 2 years. They're just going to see where your diploma came from, and if it's the same as all your peers, years, then there you go. All right, the next milestone you should be hitting, which should help with the first milestone of paying off debt, is to get a job where you can earn income and get experience. In your 20s, you want to try out as many jobs as possible and earn income at the same time. One of the things that you should strive for before the age of 30 is that you've hopefully found a career that you love and that you can work in for a while, because the highest earning potential usually comes from being in the same industry for a long time. Think of it this way: would you rather hire a plumber that has 1 day of job experience or someone who's seen 20,000 clogged toilets in their life over the span of 30 years? You'll probably want that second plumber because he knows exactly how to fix your pipes in a fraction of the time. The people that can demand the most amount of money in the market typically have been in their jobs for a long time. So in our 20s, we want to figure out what that is, or at least hone in on exactly what that's going to be. Now, if you don't find your job for life in your 20s, that's no sweat either. This milestone is more about getting experience working. Having experience is one of the most valuable things you can learn because it'll also teach you of how important it is and how hard it is to make money. So I used to think in high school that $100,000 a year was going to be so easy to make until I actually started in the workforce and realized, like, man, this job is going to take me at least 5 years of working really hard. Right now I'm being paid $40K and it'll be a long time before I hit $100,000 a year. That was really eye-opening for me, and it really taught me the value of money and how hard it was to make. Assuming you get a job, the next major milestone in your 20s to hit is a triple threat, and they all go together. So I'm basically going to call this milestone the trifecta milestone, and it consists of the following. Number 1, delayed gratification. Number 2, staying out of credit card debt. And number 3, building your credit wisely. So let's break this down. Typically in your 20s is when you'll get your first credit card. Now, credit cards are not evil per se, but they can really help you build your wealth in the 20s, especially if you use them correctly. That means you want to pay off your credit card in full so that you don't fall into the recurring cycle of owing money on your credit card. Credit card interest rates are on average around 18%, so these can really kill your financial foundations if you aren't responsible with your spending with credit cards. If you are able to stay responsible with your card, you're going to be able to build some solid credit. The biggest benefit of having a great credit score is getting a lower interest rate on loans and financing for homes and cars. Having a good credit score can also help you get approved for rentals faster. Now, a lower interest rate, I know it sounds like a boring benefit, but on a mortgage, for example, the difference in just a 0.5% interest rate is absolutely crazy. On a loan amount of $400,000 with a good credit rating, you might qualify for a loan rate of 5%, which amounts to $373,000 in change in interest over 30 years. Now, pretend you have a slightly worse credit score, and that means you qualify for a 5.5% interest rate. Over the course of 30 years, that same loan is going to cost you about $417,000 in interest. That actually amounts to a difference of $44,000 over the course of the loan. That's crazy because getting a good credit score is not that hard as long as you pay off your bill on time and you stay out of too much debt. Now, here's the thing though about that: you can never miss a payment. So to illustrate how important this is, if you make 99% of your payments on time, you basically get a B. So literally with a credit score, you cannot afford to miss any payments at all, and that's why you should always have on auto pay when you can. And the last part of this trifecta milestone is simply delayed gratification. If you can delay your impulse purchases in your 20s, you're going to have an easier time compounding your wealth for the future, and that's simply due to the fact that $1 today is going to be worth more than $1 in the future. The more capital that you can accumulate when you're young, that means the bigger the base is going to be that you're going to have when it comes to investing and compounding your wealth. So let's pretend we have a person, A and B. They both don't invest from the ages of 20 to 30, but at least they save money. Person A saves up $500 a month, so by the time that they're 30, they have $60,000 ready to invest. Person B, on the other hand, they save up $750 a month, so they have $90,000 by the time that they're 30 ready to invest. Now pretend at the age of 30, they both start to invest in the market and they get 8% until they retire, and they both do the same thing. By the time they're 65, person A is going to have an $887,000 ending balance, while person B is going to have over $1.33 million. That's a difference of $443,000 just because person B was able to save a couple $100s more per month than person A from the ages of 20 to 30. So the next time you're looking at buying those Gucci slides, think twice, because by delaying that purchase, you might be able to afford something way nicer later on in life, like a pair of Crocs. That was a joke. Hopefully you got it. The next big milestone in your 20s you should accomplish is having a savings goal, either for a house, a wedding, a dream vacation, or taking a risk like starting a new business. Having a savings goal, I think, forces forces you to create a budget, and that way you can work backwards from the goal itself. A big part of your 20s is navigating the fact that you'll be making an income, and your goal is to not spend all of it. In fact, if you can live below your means, it's almost always a good idea because it kind of goes back to this idea of delayed gratification. By living below your means and as you start to earn more income, you're going to be able to save for big goals like that down payment on a home, a wedding that you've always wanted, or an engagement ring. I know for me personally, I've been spending roughly the same amount of money every single month since the year 2014 because I track it in my expense tracker app. Starting out, I was spending about $1,500 a month on all my discretionary expenses, and I wasn't really making that much money at the time, about $45,000 to $50,000 a year. So basically, my income relative to my expenses was not that great. In fact, I was barely saving any money after taxes. But as my income personally grew, my expenses have always stayed roughly the same, and I've been living like I make $50,000 a year this entire time. Now, as a result of that, I now have a lot of money saved up, and I'm thinking about either putting a down payment on a house or a rental property in the Bay Area, which, let me tell you guys, is not cheap. Heck, I can even afford a lovely engagement ring without even having to worry about it damaging my finances. So, if you happen to be Taylor Swift watching this video,
oh, hey.
Or maybe another single lady, make sure you DM me. All right, all jokes aside, I was able to achieve this because I just really haven't changed my lifestyle that much. The thing with increasing your lifestyle and buying new clothes or new shoes is that they'll make you happy for like a temporary amount of time, but after that initial honeymoon period ends, your happiness level is right back where it started. So in your 20s, you really want to focus on the things that make you happy that aren't tied to spending more money, and that's going to go a long way in your life. Okay, but now you're probably wondering, what's the right amount to save? The next major milestone you should hit is building a budget. Now, many financial experts recommend the 50-30-20 rule, which helps you distribute your income. We'll get right into that, but first, I want you guys to do the following, and it's going to take you about an hour or two, but it's going to be well worth it. Basically, you're going to go into your bank statements and your credit card statements and just comb through them. Categorize each expense into a need versus a want. If it's an expense like rent, utilities, car insurance, health insurance, that would be a need. If you have discretionary spending like Jamba Juice, Waffle House, or Netflix, that would go into the want category. The 50-30-20 rule states that your income should be divided 50% into needs, 30% into wants, and 20% into savings. So that means if you're making about $5,000 a month, $2,500 would go towards your needs like rent and utilities, $1,500 would go into discretionary, and $1,000 should go towards saving for future investments. And speaking of investments, this next part of the video is the fun part. Assuming that most of you guys have most of your debt out of the way, a working budget, an income, and at least an emergency fund, this is where you want to start investing for the future, and you can do so starting in retirement accounts. In America, there are two types of retirement accounts that most people will want to open. The first is the Roth IRA, which is an individual retirement account, and the second is a 401k, which is an employer-sponsored account. Now, both of these accounts have a Roth and a traditional version. The main advantage of having a Roth IRA is that your earnings and profits are growing tax-free. That means when you retire and you withdraw all the earnings on this account, you won't pay any taxes on it at all. That's what the Roth portion of the IRA denotes. It's tax-free when you retire, but when you put in money, it's actually taxed. Now, this benefit is so good that the government limits how much you can contribute to it. If you're under the age of 50, you can only contribute $6,000 a year into a Roth IRA. And if you're over the age of 50, you can contribute $7,000 a year, an extra $1,000 as a catch-up mechanism. The other notable thing is that you need to contribute to the Roth IRA, like I said, with after-tax dollars. So in a traditional IRA, money going in is going to be pre-tax, but coming out, you will be taxed on it. In a Roth IRA, it's the exact opposite. Money going in is going to be taxed already, so when you withdraw it, they're not taxed at all. Now, in order to contribute to a Roth IRA, you need to have what's called earned income, which means that you need to get your income working for someone else, yourself, or from a business that you own. You can open up a Roth IRA at any brokerage like Fidelity, Schwab, Vanguard, Wealthfront, Acorns, and all of these brokerages should make it really easy for you guys to sign up for one. Once you sign up for one, though, you want to transfer money from your normal bank account to your Roth account, and then the final step is to actually purchase some investments in the account. We're going to talk about what to invest in shortly, but first let me cover the 401k really quickly. So the 401k, traditional or Roth, is an employer-sponsored account. That means you can only start it if you work for an employer that offers it as one of their employee benefits. Now, many corporations will offer this type of retirement account, and it's pretty common across most companies. You can contribute a portion of your paycheck into the 401k, and this account has a much higher contribution limit of $20,500 per year in the year 2022. Anything you contribute to this account in the traditional 401k is pre-tax dollars, which means that
that you get taxed later on, but basically you defer your taxes till later. For many people, their income and therefore their tax rate is going to be lower at retirement, so they're paying a smaller amount of tax on the money in the future, and that's why they would want to defer their taxes until later. Now, because this is a retirement account, you're going to be taking penalties for withdrawing any funds from it before the age of 59 and a half. Now, after the age of 59 and a half, you can withdraw penalty free. Now, one of the biggest advantages of the 401k is that if your employer matches the contribution, that's basically like free money. So a lot of employers these days offer a 401k match, which is a benefit if you work at a company. So oftentimes, if you contribute 5% of your paycheck to your 401k, companies will match your entire contribution up to a certain amount. That means it's like free money for you and your retirement in the future. So if your employer offers this is an absolute no-brainer. You must do it because it is free money again, and it is going towards your future anyway. The last thing to note is that yes, you can have a 401k and a Roth IRA at the same time. So after you have either one of them or both of them, you need to figure out where to invest the money. For most people, investing in an index fund or ETF is all that you need to do. So an index fund is a type of pooled investment that you can buy in your retirement account or brokerage account. Now, when it comes to index funds, an index fund is basically a pooled investment that buys into many different other investments. So for example, if you were to buy an S&P 500 index fund, by buying that one fund, you would own a small percentage of every stock in the S&P 500, thus you track the entire index. That would automatically provide you with diversification because your investment is now spread across the top 500 companies in the US. And by buying an index fund, it's actually way cheaper than buying into each of these 500 companies individually on their own. Index funds are usually safer bets in a retirement account because based on the average over the course of the past 80 years, index funds have been proven to return about 8% a year. Some years are going to be higher than others, but on average, you can expect your money to grow and compound over time. The index fund I love is ticker symbol VOO. It's Vanguard's S&P 500 ETF. Now, while this is not financial advice, I personally invest in that one. You can invest in what you like. There are a ton of ETFs and index funds out there. If VOO or your ETF is not available in your 401k, just look for another type of index fund that invests in a lot of companies in the United States, and you should be at least pretty good. For those of you buying index funds, you want to make sure that you hold them for the long term. If you make huge changes whenever the market fluctuates, you might miss out on some gains. So Bank of America found that since the 1930s, if you sat out the 10 best days per decade, your returns would be just 45% versus the alternative 20,000%. They also found that the probability of losing money over one day in the stock market is a little worse than a coin flip at 46%, but the probability of losing money in the market declines to just 6% if you are invested for at least 10 years. Another reason why it's crucial to stay invested is because usually the best days in the market follow the worst days, and it's truly impossible to perfectly time the market. That's why time in the market is much more important. JP Morgan found that 7 of the best 10 days in the market occurred within 2 weeks of the worst 10 days of the market. For these reasons, when the markets are down, just don't touch your investments, and especially if they're in a retirement account, you can just buy them and basically forget about them. Chances are in 30 to 40 years, the market will be much higher than what it is right now, and anything you bought in your 20s will seem like a great deal then.
Your 30s are a decade of a lot of spending, whether that's buying a home, having some kids, or perhaps just getting married. It seems like you're always being spread thin. And as someone in their 30s right now, I've thought deeply about the financial milestones that we should be hitting in order to be financially sound by the time we're 40. So whether you're in your 20s looking ahead, you're in your 30s like I am today, or perhaps you're in your 40s and you're wondering if I've made all the right decisions, this video is for you. The first financial milestone you want to hit in your 30s before the age of 40 is to have $0 in debt. Now, the one exception here is if you have a mortgage. That means we're aiming for $0 in consumer debt, so ideally you have no credit card debt, as well as the fact that your student loans are paid off. And in my own perfect world, it would be that you do not have a car payment, so ideally your car is paid off, because the average expense for an American these days is closer to $700 a month for a new car. The idea here is that in your 30s, you're in your prime earning years, and so therefore you just really want to ramp up your net worth, and the last thing you want is consumer debt dragging you down. In addition, in your 30s, that's where everything in your personal life is going to start to intersect. You might have more responsibility at work, you might have 1, 2, 3 kids, or even some pets. and you might have to start taking care of your elderly parents. Now, for me personally, when I was in my 20s, I had a really healthy and somewhat young father, and therefore I didn't really have to take too much care of him. However, these days I find myself spending a lot more time with him because he's just getting a little bit older. He's getting a little slower, just both physically as well as mentally. And sometimes I use my own money to solve certain situations. So for example, I don't know if you guys have parents that are stubborn, but my dad is particularly stubborn and wants to do everything himself. Just last week, we had a sink that was clogged, and this man wanted to go in and just fix it himself, DIY it, if you will, but I knew that that just wasn't gonna happen. So in these situations, I just like to fix it myself, either by doing it myself, by looking it up on YouTube with my time, or I'm just gonna pay a contractor or plumber to come out and fix it for us. And if you still have consumer debt in your 30s, I think this is a perfect time to tackle that, because if I still had a bunch of consumer debt, I probably wouldn't be able to help my parents as much as I can right now. Debt can add layers of complexity into your life, and so I'm always a big proponent of trying to keep your personal burn rate as low as possible. That way it gives you a lot of flexibilities and options down the road. Now, we're still gonna keep our mortgage loan in our 30s because it's unlikely that we can pay that big of a balance off. That's what our 40s and our 50s are going to be for, and that'll probably be in a future video. All right, the next financial goal or milestone that you should hit in your 30s is to have an excellent credit score above an 800. The biggest benefit of having a great credit score in our 30s is going to give us a lower interest rate when we're trying to buy our first home or perhaps refinance that mortgage that we might have. I know that a lower interest rate sounds like a boring benefit, but let me show you guys the math and how big of a difference just a 0.5% interest rate is gonna be. On a loan amount of $400,000 with an excellent credit rating, you might qualify for a loan rate of 6.5%, which is current interest rates, and that amounts to $510,178 in interest over the course of 30 years. If you have slightly worse credit, so not even just like awful credit, just slightly worse credit, you might be able to qualify for a 7% interest rate. That amounts to $558,036 in interest, which is a $48,000 difference over the course of that loan. Now, getting a good credit score is actually not as hard as it sounds. As long as you're paying your payments off on time every billing cycle, it generally tends to go in the upward direction. However, if you do miss one payment and it's more than 30 days late, that can actually tank your credit score. According to LendingTree, quote, a late payment, typically over 30 days, can drop your credit score by as much as 180 points and may stay on your credit report for up to 7 years. So that really re-emphasizes the fact that you should just never have a late payment, because one late payment could drop your score from say 780 to 600, and that's a huge difference. If you're not quite there yet with an 800 credit score, take some time to figure out how credit works. I have a lot of guides on this channel, and if you're already pretty close, sometimes it's just more of a matter of time. The next financial milestone in your 30s is to consider assembling a financial plan for the next 30 years of your life, all the way up until retirement. Now, a good financial plan will tackle a few different categories that are pretty important, and I like to use the acronym BRET. So B stands for budgeting and saving. We should know intimately how much we need to save and spend in order to hit our goals for retirement. The R is for retirement planning. So in addition to knowing what our goals should be, we should also know exactly how far along we are and any other plans that we might need to make in order to retire. The E is for estate planning. I know it sounds a little bit too early to get started with this and what it may look like. However, if you are in your 30s and you already have a kid, this might be a good time to start thinking about it. And the T is for tax planning. Do we have the right strategies in place with our financial plan? So when it comes to this milestone in our acronym of BRET, B-R-E-T, it might make sense to actually hire a financial planner if we decide we need that. The fourth money milestone or goal to accomplish in your 30s is to have a well-stocked emergency fund. In our 20s, we wanted to create a financial foundation for ourselves, and that was done with a 3 to 6 month living expense emergency fund, and I think that goal in our 30s should even be more prioritized than it was before. That's because in your 30s, the more responsibilities that you're gonna have in life is gonna create a lot more pressure on you in general. The kids that you have, the house that you have to maintain, perhaps elderly parents that you might have to take care of, all of these new responsibilities can require some extra cash from you in the form of a liquid emergency fund, especially if things go awry. What happens if your kid needs an emergency surgery, or perhaps your water heater breaks in your house, or perhaps someone just comes to you with a great investment opportunity? It's gonna be really nice to have some liquid cash laying around. Because of this, I think it's even more important to have a well-stocked emergency fund in your 30s, and I would even consider going up to 12 months of living expenses saved up, and that's gonna be on the very conservative side. Ideally, that's being saved in a high-yield savings account, earning you some interest. If you don't have one yet, I will link some down below as well. But the general personal finance rule of thumb here is that you have 3 to 6 months of your living expenses saved up in an emergency fund, and if you already have that and you're good with that, then great. rate. If you don't have one of those just yet and you're in your 30s, psychologically, it actually is a lot easier if you break down your emergency fund goal into smaller bite-sized pieces. So for example, instead of trying to save $10,000 or $20,000 in an emergency fund, maybe just try to save $1,000 every couple of months or maybe every 3 months. That's gonna be a lot more attainable. The fifth financial goal to accomplish in your 30s is going to have at least 3 times your annual salary saved for retirement by the time you're age 40. According to the Bureau of Labor Statistics, the average annual income of somebody in the United States by the time they're the age of 40 is $62,000. That means by the age of 40, you should have 3 times that saved in a retirement account or just in general savings in order to get you to your retirement goals, and that amount is going to be around $186,000. By doing so and using a retirement calculator like this following one from NerdWallet, we can assume with investments that you should be able to get to a balance of $2.11 million by the time you're the age of 67. Having a considerable amount of money in your investment account by the time you're the age of 40 is going to be really important because that gives us at least 25 more years of compounding in order to hit our retirement goals. Now, if you haven't reached that point quite yet, it's important to not get discouraged because while you're in your 30s, you still have at least 2 to 3 decades left for retirement, and that's still a lot of time to compound your wealth. Personally, I think that if you're watching this channel, I would love to know from you down below if you guys are on pace for this goal, you're ahead of this goal, or perhaps you're a little bit behind this goal. If you're younger than the age of 30, then 3 times your annual salary by the time you're age 40 is a good North Star goal to have. Ideally though, if you're part of this community, I want you guys to aim even higher. So go for 4x, 5x, maybe even 6x your annual salary by the time you're age 40. That's gonna make things so much easier for you guys down the road. The 6th financial goal in your 30s is one of my favorites. It's to avoid lifestyle inflation. You're probably making a lot more money in your 30s, and the best way to sabotage that is spending too much of that new money. One of the lessons of the book, The Millionaire Next Door, right here is the fact that most people who are great accumulators of wealth are actually not spending too much of their income. They often try to keep their lifestyles as cheap as possible, and therefore that difference between how much they make and how much they spend allows them to accumulate wealth like no other. On the flip side, many people that look really well off are actually in deep debt. The book goes on to say that physicians and lawyers, while they do earn above average incomes, they tend to spend a lot more money because they want to drive the same cars or live in the same communities as their colleagues do. And these are the same people that struggle to pay off their student debt. They still have high mortgage balances, as well as the fact that they might live paycheck to paycheck even on a large salary. The author found that the millionaires that accumulated their wealth the quickest kept their spending at the same level or just increased it very, very slightly while their incomes rose. My favorite analogy of the book so far is the fact that if you have a growing income, that's known as having a good offense, and if you have a good defense, that means you're not spending as much money. One of his famous quotes in the book is the following, quote, "Great offense and poor defense translate into the underaccumulation of wealth." And quote, "The foundation stone of wealth accumulation is defense, and this defense should be anchored by budgeting and planning." Essentially what he means is that you can have a really strong offense, but if you don't have a good defense, you're not going to be accumulating wealth in the potential that you should be doing. For example, I have a lot of friends that are in really good jobs here in San Francisco, and they make a lot of money, 500K, 800K, even up to $1 million, but they all spend a lot of that income. So at the end of the day, someone who's making 500K a year, if they're spending $450,000 of that income, they're not actually making progress into financial freedom by accumulating that wealth. You could be earning a lot less of an income, yet you're saving a higher absolute number of dollars just because of discipline and budgeting. And so it really goes to show you that even if you don't make as much as, say, a really high earner, it's still able to be done. Obviously, would we rather just want to make a lot more money? Yes. Obviously that would be the best thing, but we got to work with what we got. The 7th financial goal to achieve in your 30s is to start to develop an estate plan. I know what you're probably thinking, like, dude, Humphrey, I'm 32 years old. Why do I need to prepare for my eventual passing? Well, the key deciding factor here isn't necessarily your age, but rather if you have dependents and also assets to be distributed in case of your eventual demise. If you do have kids, you probably should start to develop an estate plan. The major components of an estate plan are developing a living will, even if it's a basic one, and also the healthcare power of attorney. These are just documents that state your preferences in case something were to happen to you. These aren't as hard to set up as you might think. Even having a basic living will is quite easy to do. You just go online, find a living will template, edit it for your own personal preferences, and then what you can do is you take it to a notary, get it notarized. They even have these at UPS stores, and that will at least make it somewhat more official. Of course, if you do have a complicated situation, you might still actually want to go to a legal professional, but just having some sort of basic paperwork is going going to go a long way. Another benefit of an estate plan is that you can designate a legal guardian for your minor children. That way you're ensuring that your children are always taken care of. Personally, I don't have an estate plan yet, but I am still single. If I were to get married and have some kids tomorrow, perhaps I would probably start an estate plan. I think it would be a really good idea at that point. The 8th money milestone to accomplish in your 30s today is to invest in your own health. While this is not a direct monetary milestone, having good health is going to lead to you living a lot longer. That probably means you have more time to make more money, which indirectly makes it a monetary milestone in my opinion. It might also mean that you have less healthcare expenses throughout the rest of your life, so it actually saves you money to invest in your good health. We should aim to have healthy habits such as regular exercise and a balanced diet, so perhaps you stay away from the ice cream and the alcohol every single Friday night, huh? God. We should also be making sure that we're getting the proper sleep that we need as well, because that's very important. Now, it's also in our 30s where our metabolism is going to start to slow down, and I know mine has, and your body isn't just the same as it was in your 20s. For example, in my 20s, I used to be able to just hop straight into a workout with no warm-up whatsoever and not have any worry about getting injured. But these days, I really need to warm up before I work out or do any sort of activity, because if I don't, I might just sprint into something and then all of a sudden my back is blowing up. I feel like I could just really injure myself at any point, and I'm only in my 30s. It's only gonna get worse from here, which is a little bit depressing, yes. However, let's just try to keep an optimistic, positive attitude, shall we? This decade, I've been really prioritizing lower impact workouts such as yoga classes and also long walks. And I think that in conjunction with super healthy habits is going to lead to a much longevitous life. There's a famous saying that says, you don't take your money with you when you pass. And I think the same vibe can be applied to longevity. It doesn't matter if you've made millions or even billions of dollars if you can't even spend it because your body isn't healthy enough to walk. The next financial goal to achieve before the age of 40 is to start a 529 plan for your kids or eventual kids if you're planning on having them. A 529 plan is an investment account that allows you to invest and save for any educational costs that your kids might have. You can even start one before your kids are born, and you just basically set yourself as the beneficiary of the 529 account, and then when your kids are finally out in the world, you can redesignate them as the beneficiaries. When you contribute to a 529 plan, you actually get tax advantages with your state, so that means you can actually get a deduction on your own state income. Plus, when you withdraw, you also are withdrawing tax-free, and all the earnings are going to be tax-free as well in a 529 plan, which makes it a really powerful account. So long as the money in the 529 plan goes towards educational expenses, it's all going to be tax-free, and you're going to pay less in tax up front. And therefore, if you're planning on having kids and you're planning on paying for your child's education, it's a really good account to have. In the event that your child does not use the full balance of the 529 plan, you can actually roll it over to the next sibling. So if you have another kid, you could do that. And if you don't have any other kids, you can actually redesignate the beneficiary to yourself for any lifetime or lifelong education expenses. We're breaking down the key money milestones you should aim for in each decade of your life to stay on track for financial freedom and a comfortable retirement. I've outlined these by decade, but the truth is that if you finish one ahead of schedule, feel free to move on to the next milestone, even if it's not in your current decade. So starting with the decade of your 20s, there are 3 major goals I believe you should be looking to hit in your 20s. The first is to eliminate bad debt. So in terms of bad debt, what I'm mostly talking about here is any debt that you have that has a high interest rate, I'd say over 12 to 15% APR. The reason is that it's hard to out-invest a high interest rate, because if you're paying 15% interest on debt that you might have, but you're only earning, say, 8% on investments, you are losing money overall. Most people can't consistently invest and beat a rate at which a high interest rate might cost them. So for example, even the stock market's long-term average return of 8 to 10% per year is still lower than the average interest rate on, say, a credit card. This means that paying off high interest rate debt is often the best guaranteed return on your money. On the other hand, if you have lower interest rate debt, so let's say you have a mortgage perhaps at a 4% interest rate, it might make sense for you to invest instead, as your expected returns could be higher. The key here is to balance your risk, your liquidity, and your opportunity cost, but I think it's always a best practice to pay off and eliminate any high interest rate debt. The second milestone at this decade is simply to have between 1 to 2 years of your annual expenses saved and invested by the time you're age 30. This means that you should add up all of your expenses, calculate them per month, and then perhaps calculate them per year, and then on that amount, you should have 1 to 2x invested for retirement. So let's say all of your monthly expenses are around $2,500 per month. That means on the lower end of the spectrum, you would want to have $30,000 invested. That would be 1 year worth of your annual expenses. Or on the higher end, you might have $60,000 invested. On average, we're seeing that 20-year-olds spend $3,863 per month in expenses, or around $46.3K per year. So a good stretch goal would be to have between $46,000 to $92,000 saved up by the time you hit the age of 30. This would actually put you ahead of most people in that age range, since the median person in their 20s has about $29,000 saved for retirement. Having 1 to 2x your annual expenses saved and invested is a really important milestone, because I think that means a couple things. First, you're on your way to retiring comfortably, and then number 2, I think in the event that there is an emergency, you can just supplement your emergency fund with your investments in the worst case of scenarios. The third milestone in your 20s is to get into the habit of saving 15% of your income. The personal savings rate in America is 3.8%, so if we can overshoot this by a good amount, it will put us in a really good position to build a strong emergency fund and also retire at a reasonable time. Starting with a net worth of 0, if you save 15% of your income, you will retire in 43 years, and that will be a very comfortable situation for you. Honestly, personal finance can be pretty solved if you're able to consistently save and invest 15% of your income, because that practically guarantees you retirement when you are older. And so if you can just automate this habit, you can just live guilt-free with the rest of the money that you have. You don't have to micromanage every expense because you're already taking care of the bigger picture. And that's literally all it takes. You can just take the rest of your 85% of the money that you have and just do whatever you want with it. Another benefit of saving 15% from an early age is that it sets the habit up and ensures that as your income rises, your savings grow proportionally. And then that way it will help you avoid any lifestyle inflation, which we all know is a huge wealth killer. Before we get into the next decade, I want to tell you about my free newsletter called Hump Days. That's where we come out with business news twice per week on Wednesdays and Sundays. If you like the content that we put out here on the channel, I think you will really enjoy getting that newsletter. I will leave a link down below for it. And once again, it's completely free. All right, so let's talk about the decade of the 30s now. It is a huge decade with a lot of spending. So whether that's buying a house, getting married, having kids, you're most likely going to be spread really thin. And as someone in their 30s right now, I've thought deeply about a list of milestones that we should be aiming to hit by the time we're 40 in order to be financially sound. Milestone number 1 is a Fidelity suggested milestone, and it's actually to have 3 times your annual income saved for retirement by the time you're age 40. According to the Bureau of Labor Statistics, the average annual income of someone by the age of 40 in the United States is $62,000. That means by the age of 40, you should have 3 times that saved in a retirement account, so about $186,000. By doing so, and then using a retirement calculator from NerdWallet, we can assume with investments that you should be able to get to a balance of $2.11 million by the time you're the age of 67. Having a considerable amount of money in an investment account to compound for the next 25 years should ensure that you can get to your retirement goals without any stress. The second milestone in the age of the 30s is to have $0 in debt except for your mortgage. So CNBC reports that the average millennial right now between the ages of 24 to 39 has about $76,000 in debt alone. This does include mortgage debt, which brings that number upward, but still the average millennial will carry about $27,251 in non-mortgage debt, as well as $4,651 in credit card debt. So our goal in our 30s is to have no debt owed on a car or a credit card or student loans even. I think the 30s are where your career really starts to accelerate, and the last thing you want is a debt burden preventing you from building wealth as quickly as possible. If you can keep your personal burn rate low on a monthly basis, that gives you a lot of flexibility as well as peace of mind when it comes to the rest of your budget. We're still going to be keeping the mortgage debt in our 30s. That's simply because it's going to be very unrealistic for 99% of people in their 30s to pay that off immediately. If you do have a high interest rate on a mortgage, you may want to consider refinancing when the rates come down, and our goal of paying off the mortgage will be a target for the later decades in life. The third milestone in the decade of the 30s is to start saving 20% of your income at minimum and to have a well-stocked emergency fund. So hopefully you've been listening to this video and you've been saving around 15% in your 20s, and then basically now that you're in your 30s, you want to level that up 5% more in order to be on track for an even more comfortable retirement. In terms of your stocked emergency fund though, Bankrate has polled Americans on their emergency savings, and in 2025, 33% of Americans have more credit card debt than the money they have in their emergency savings. That's pretty crazy to me because that means 1 in 3 people still have that much debt, and that's not what we want on this channel. In your 30s, it's imperative to build a larger emergency fund because you may have way more responsibilities in your 30s, including a home, kids, and your parents. You might be even taking care of them. All of these new responsibilities could present emergency situations in which you might need liquid cash. Now, if you are on the conservative side, I would actually recommend having up to 12 months of living expenses saved up in a high yield savings account, but the general personal finance rule of thumb thumb is typically to have 3 to 6 months of expenses saved up. And basically, if you're already there, then you're already doing really great. All right, now let's head into our 40s. So this is going to be a crucial decade because you're still basically building your career, but also solidifying your long-term financial future. Your lifestyle has probably inflated slightly, but you are well established now and you've increased your earnings, but you may have even more financial responsibilities in your 40s than you did in your 30s. Retirement is starting to get closer and closer, especially as you near the 50-year-old mark. So we need to actually start planning for retirement as well as having a plan for the rest of life as well. So in your 30s, the focus was on consistently saving between 15 to 20% of your income for retirement, but in your 40s, the priority shifts to ensuring you're truly optimizing your savings. Every additional dollar you have invested now has less time to compound, so making the most of your contributions is going to be essential. So that means as you enter your 40s, one of the most critical financial milestones is maximizing your retirement contributions. This includes accounts like the Roth IRA, the 401k, the Roth 401k, or any other tax-advantaged retirement savings accounts. Take the Roth IRA, for example. If you only contribute half of the annual limit, which is $3,500 per year in your 40s, and you assume a 10% annual return, you would still accumulate $378,000 by the time you're the age of 65. But if you were to max it out every year, you would actually retire with double that, so $757,272. Now, what's crazy is that the average 40-year-old in America is falling behind. So according to Fidelity and CNBC, the average 401k balance for people aged 40 to 49 is $105,500, but the median balance is only $34,100. By the time we hit the end of our 40s, we should definitely aim to eclipse these numbers and hopefully have close to 5 to 6 times our salary saved for retirement. And the way that we're going to do this is by simply maxing out your retirement accounts and to continue to take action on this throughout your 40s. The second milestone in your 40s is to try to build one more income source. So that could mean establishing a rental property, perhaps having dividend or investment income, or simply having a side hustle or side business. The idea here is that you don't really want to be reliant on just one single income source going into your 50s and 60s. So having even a semi-passive or passive income stream can really help you provide financial stability, help reduce pressure, and gives you more flexibility in your long-term financial planning. For example, let's say you start a small online business, perhaps you're selling digital products, or perhaps you start consulting in your area of expertise. Over time, let's say it generates an extra $500 to $1,000 per month. That's really great because that's money that could cover key expenses or be reinvested for future growth. Similarly, you could also own rental property that brings in positive cash flow, which can help supplement your main income source while building long-term equity. The key here is to create an income stream that works for you, even if it is small, so that you have some financial options and security in the decades ahead. Third financial milestone in your 40s is to have an estate plan. So that's especially true if you have dependents that rely on you. If you have dependents as well as assets that need to be distributed, you should probably have some sort of estate plan or at least get into the process of at least starting one. 34% of people between ages of 35 and 54 have never discussed estate planning with anyone, so we want to be sure that we are not one of those people. Now, the major components of an estate plan are pretty simple. You need a living will and a healthcare power of attorney. These two documents state your preferences in case something were to happen to you, and you can find a basic template for, let's say, a living will online. You would then edit it for your personal situation, and then you could get it notarized so that it becomes more official. Of course, the more complex your situation is, you may want to look into a legal professional, but having something even basic in writing, I think, is better than nothing. Other benefits of estate plans can include the fact that you can designate a legal guardian for any minor children you might have so that they are taken care of by someone you trust in case something were to happen to you. All right, now that you're in your 50s, this is the decade where retirement is just around the corner, so it's no longer a distant goal anymore. By this point, you're likely in your peak earning years, but you also have tons of financial responsibilities like helping your kids go to college, paying off your mortgage, or just catching up on retirement savings. Every decision in your 50s has a direct impact on how comfortable you'll be in retirement, and so for the milestones in this age range, it's imperative that you act with urgency. Milestone number 1 is to run a retirement budget test. This is basically where you're going to live off of your projected retirement income for a period of 3, 6, or even 12 months to see if it's feasible for you. Many people assume they'll be fine based on rough estimates, but living on your projected retirement income for 3, 6, or even 12 months can help you identify gaps or places where you spend too much money, and then you'll have the ability to basically make adjustments while you still have that time before you retire. Fidelity recommends living off of a 55 to 80% of your income in retirement rule. So an easy way for you to do that is to take your current monthly income, multiply it by 80%, and see if you can live off of that for a few months or even half a year. If you really want to go hard on this category, you would keep track of every single category that you spend money on and then stick to a strict budget for the entire period that you've chosen. chosen. At the end of the period, you would identify if you underestimated or overestimated any of the expenses that you projected. This will help you avoid surprises and even course correct early so that you can retire with more confidence. Milestone number 2 in the 50s is to pay off your debt, including your mortgage. So I think that this is a really big milestone because getting rid of this debt will dramatically reduce your living costs, since for most people, housing is their biggest cost in retirement. This will also provide a ton of peace of mind, as all you really have to deal with in your 60s and retirement is going to be paying property taxes, insurance, and utilities, which I think is so much easier to mentally handle. Lastly, if you're able to pay off your mortgage early, you can allocate all that extra money that would be going toward a mortgage payment to your retirement instead. Milestone number 3 in your 50s is to make sure you have 8x your salary saved for retirement. That means if you're making $80K per year in your 50s, you should have at least 8 times that saved by the time you're 60, so $640,000, and that's going to be for your retirement fund. This is a target estimate provided by Fidelity, but I find it pretty accurate as it will set you up for success by the time you're in your 60s and beyond. One advantage you have in your 50s is that you can contribute more to your retirement accounts because of catch-up contribution rules. So I think, having 10 to 15 years still left before retirement, that's still a lot of time for your money to compound. So you really want to use this time to boost your retirement savings. All right, the last decade we're covering today is the 60s, and it's in this decade that you should be focusing on preservation of capital. It's no longer about accumulating all the money in the world, but now more about the optimization of the money that you have. So milestone number 1 in this age range is to decide on when you should take pension or Social Security benefits. You can start taking Social Security in the United States as early as age 62, but your benefits will increase if you're able to wait. Social Security benefits are reduced by upwards of 30% if you start receiving them before your full retirement age of 67. Now, on the flip side, if you're able to wait until the age of 70 to start taking Social Security, you could actually get the maximum benefit, which could amount to 8% more per year for the rest of your life if you can wait those extra 3 years. Milestone number 2 in the 60s is to adjust your investment portfolio for lower risk and fixed income. Typically in retirement, your portfolio will no longer consist of high-risk stocks, and your exposure to bonds, dividends, and stable assets will increase. Because your income will be inconsistent after you retire, it'll be nice to have a portfolio that isn't so volatile in retirement, and most retirees will aim for a portfolio with at least 55% in fixed income investments. That means the remainder might be in stocks or alternative investments as well. Ideally, in your 60s, you should also be diversifying your investments even further, so perhaps you're investing in businesses, real estate, or other types of alternative investments. Milestone number 3 in your 60s is to figure out your purpose and plan your lifestyle in retirement. Oftentimes when people retire from their jobs, they lose a little bit of their sense of purpose, so I think a really good thing to figure out before you retire is what will drive that fulfillment when you do have more time in the day. You could consider part-time work, a consulting job, volunteering, or a passion project. I mean, ideally you find some sort of activity or hobby that keeps you mentally engaged as well as engaged with a community. I find that as humans, we are much happier when we have something we're working on that we like, as well as we're hanging around the people that we like as well. I want to break down 7 reasons why you might feel behind financially, and we'll actually uncover if there's any truth to these at all. Number 1, you judge a book by its cover, so appearances on the surface usually aren't an accurate depiction of somebody's wealth, and let me give you an example with cars. There's always a big misconception that what you drive is reflective of how much your net worth is or how much money you might be making. Pretend you have $600 a month to spend on transportation. Well, you are a reasonable and modest person, let's say. You go out and finance a used 2021 Toyota Corolla hatchback that has a price of $25,000. Your car payment is about $424 a month, and after everything is included in terms of gas, insurance, etc., you're probably close to a $600 a month car payment for that used car. Your goal is to pay it off in 5 years, and then you just own the car outright, and therefore you don't have to make any more payments. But then you have a friend, let's just call him Eric, and you're both at the work water cooler one day comparing finances, as many good coworkers do, and you find out that he makes the same exact yearly salary that you do. Eric shares with you that, man, his car payment is killing him, and he confides in you that it's actually $459 a month for his car. You look at him strangely because, well, something doesn't really add up. You're paying close to what he pays and you're driving a Corolla, but Eric over there is whipping around in a 2025 BMW i4. Not to mention, this really confuses you because you guys make the same amount of money. So you figure he must be lying. A 2025 BMW BMW i4 retails for at least $53,000 when you Google it, and there's no way he has a car payment that's remotely close to yours. Now that's where you would be wrong, because Eric is indeed telling you the truth. What he's not telling you though is that he's leasing the car and he got a lease special. His lease only lasts 3 years, so he has to give up the car after that, and not only that, he had to put up $53.89 due at signing that he didn't tell you about when he was complaining about his car payment. His insurance and gas are both higher as well, and that's not something he shares with you either. Now on the surface, both of you guys are spending roughly the same amount of money on a monthly payment, but if we dig beneath the surface a little bit, we can clearly see that Eric might be living beyond his means, all for appearances. Judging a book by its cover is one of the ways that you can torture your mind, because it easily can become a thing where you start to feel inadequate or insecure about your own finances. What you really want to focus on is just focusing on what you can do and what you can control, and trying to put blinders everywhere else. Number 2, spending habits are invisible. So let's pretend you are someone who loves to invest money, spend on experiences like going to the Taylor Swift concert, or perhaps you like to ride a camel in the desert. But then you might have a friend, let's call her Chloe, and she likes to spend money on the car, the bag, jewelry to the nines, and she gets her hair done every single month. However, Chloe doesn't invest any of her money, and when it comes to experiences, she'd much rather just Netflix and chill. So who's actually living a richer and fuller life? I would like to argue that you are, but maybe Chloe thinks that she is. While you might not have the possessions Chloe has, you have an investment account that is growing, your financial peace of mind is improving daily, and you have lived a lot of different life experiences. The truth is that spending habits can be visible depending on what your preferences are for spending money. If you like to spend on material things, perhaps you like Back to the Future posters like me, it's going to be noticeable. Now, if you like building your wealth in the shadows, well, it's just not going to be as visible, so you really can't compare yourself to someone who might be of the former, and that actually brings me to my next point. Number 3, people that have money won't actually show it off on social media. One problem I noticed that we as humans have is that we fall prey to easily looking to social media for role models or inspiration on how we should act, what to wear, or what to buy. But in my opinion, true wealth is pretty silent and actually not actually visible at all. So there was one time I went to go and meet my friend's dad for a lunch, and he's worth over 9 figures. And guess what he wore? He wore shorts and a simple polo shirt. Honestly, from the outside, he probably looked like your average Joe dad. He wasn't driving a fancy car. He wasn't wearing a flashy watch, and nobody would certainly know that he was rich. And oftentimes the most wealthiest people that I meet in my own life generally are just the most down-to-earth and humble type of people, and they honestly don't try to be too flashy. Another story I want to tell you guys is that I grew up with a lot of really wealthy kids. Now my family, we were well off, yes, but we weren't super wealthy, and one of the wealthier girls that I knew would always be traveling, and she would share photos of her family trips on social media. But what I noticed about it was that she would make it look very normal, like she would only showcase normal places that everyone had access to. For example, she went to Rome, she might take a picture of the Colosseum or the Trevi Fountain, but she never was really showing you where she was staying or how she even got there. But at some point in my life, I got pretty nosy, so I asked some of her friends who are also my friends, like, how come she never just like showcases where she stays, or perhaps how she gets to the destinations that she gets to? Well, it turns out she was flying private everywhere, staying at really nice villas and 5-star resorts, and what I actually realized at that point was that wealthy people, they want to keep their wealth a secret, because that way it's more anonymous, it's more private, and that also just means they're going to be more secure. And a huge pitfall of society is that we see people with flashy cars or flashy bags on social media and just assume that those are the people that have money. But studies suggest that a significant portion of luxury goods are actually purchased using credit cards. This is true particularly among younger demographics, and according to a Bain & Company report, luxury sales are actually being driven by younger generations like Gen Z and millennials. So just like earlier, you don't see what other people's financial situations look like. It's rather opaque, so I just don't want you to believe everything that you see on social media. Number 4, a big problem today is that we are always trying to compare ourselves upwards in society. So what I've noticed is that people don't like to compare themselves to someone less fortunate than they are. It's not aspirational to compare yourself to someone that doesn't have that much. Comparison is truly the thief of joy, but if you ever compared yourself to those that have less than you, or even yet those that don't even have a reliable source of food, water, or shelter every day, that will give you the perspective that the life you live is probably 10 times more comfortable and could be way worse if you were just born in a different country or perhaps a different set of circumstances. Part of that is just the hand that you're dealt. You can't choose where and who you are born to. You can only make the best of the situation that you have. Now, one of the ways that in our society we like to compare ourselves upwards is often with job title and career path comparisons. This type of comparison can be misleading because job titles don't always reflect true value, skills, or progress. For example, being a VP at one company can have the same responsibilities of a senior manager at another. Titles vary so much by company, industry, or even what area of the country you live in, so I don't think they are reliable at all. Now, if you work at a startup, you should know that title inflation is a real thing. Startups need to keep their employees around, and sometimes giving someone an arbitrary title to make them feel better is basically a tactic that founders and CEOs will use to make people kind of stick around. Instead of comparing yourself to your friends who have different titles, try to think about your skills. Are you developing your skills still? Are you happy at work? Are you satisfied with the work that you are doing and the value you are creating? These are going to be much more reliable markers of true career progress. Lastly, I think instead of focusing on other people's titles, you should think about whether you are growing as a person. Are you gaining more skills? Are you moving closer to your own goals? Or are you feeling stagnant? If that is you and you feel stagnant, then you might have to do something about it. That is going to be a much better use of your time and also more fulfilling than just comparing yourself to someone who has a much higher title. Number 5, expecting too much too soon. So another reason why it may feel like everyone seems to have more money than you is that we see stories highlighted all the time online of people turning small amounts of money into large amounts of money. For example, on Reddit's Wall Street Bets, if you read this subreddit for fun, you will inevitably see some gains that make you question if you should still continue working at your job. It can be really discouraging when someone makes $100,000 in one trade in just a few days when you work the entire year and you don't even make that. Or perhaps when a trader turns $80,000 to $1.12 million in just a week. The thing is though, is that you are literally only seeing the wins on this subreddit and rarely are people posting losses. Now, if they are posting losses, they are so bad that if that happened to me, I think I would be at least in a state of shock for at least a year. Like for example, this lurker who lost their entire life savings, and if you read the post, it is actually quite sad. He says, quote, "I would do anything to go back to where I was before the big sell-off on Friday, and yes, it was spy calls that killed me." Now, if that were me, I would probably need 5 to 10 years to recover from that, not just a year, but this sort of stuff happens all the time. It's just not really publicized. Sure, maybe one person out of 10 million actually does something crazy, like when they turn 80K into 1.12 million, but that's only because it worked out. For 99.9% of people, there's no such thing as a quick buck, and oftentimes making money does take a lot of sacrifice and diligence when it comes to sticking to something day in and day out. Now, on the topic of sacrifice, number 6, the grass is greener syndrome. You may assume that someone who has money did not work for it. It's easy to look at others and assume that they're better off, but this is a classic case of the grass is always greener. The truth is that you don't really know what sacrifices or struggles they're facing behind the scenes. They could have worked on an oil rig for 10 straight years, never seen their family, and put themselves at risk for different types of cancer in order to make a really good salary. Or you might see an investment banker who's making a lot of money, but then you don't realize that they're actually working extremely long hours, up to 100 hours a week early on in their careers. They also need to be constantly available. They're often highly stressed just so that they can make a good salary when they're younger. So when you do finally see someone at the age of 30 who has, quote, made it, perhaps they had to give up a lot of their life for it. And these are the sacrifices you may not want to make. If you recognize this in particular, it will help you stop comparing your achievements to theirs because maybe their challenges were bigger than yours. Finally, number 7, the silent cost of family wealth. Another factor to consider is that some people appear wealthy because they have family financial support or generational wealth. This doesn't mean that they didn't work hard, but they may have had a huge head start that makes their financial journey look a lot easier. For example, someone might afford a luxury apartment or frequent vacations not because of their job, but because they receive regular financial support from their family. Or maybe they just inherited investments or a property that gives them a cushion that many other people don't have. You never know what's on that other side. They may have more emotional baggage that comes with this. You just don't know. The key takeaway here is that family wealth and generational support can create an illusion of financial success that's not solely based on their own achievements. It's not something you can control or compare yourself to, so I think just focusing on building your own path can help you find more satisfaction and motivation with your life. So spend time on what makes you happy, what brings you ultimate fulfillment, and remember to focus only on the things that you can control and try to just put up some blinders up for society and everyone else, and I think you're gonna be a lot better off. Thanks for watching this video. If you wanna watch my next video, it's going to be right here, and I will see you either in that video or a future one on my channel. All right.